Good morning, all. Quickly, by the way, welcome to the third week of the financial institution sessions. I put some pre-class activity in the third module, like about the class. Can you quickly go through it and fill the form? This is the link I'm talking about. Yeah. Let's have the roll call simultaneously. Marcella? Yeah. Jaden? Yeah. Hendrik? Daniela? Colleen? Christian? Samantha? Jaden? Chloe? Cameron? David? Daniel? Garrett? Brennan? Aaron? Courtney? Juliana? Ayana? Mason? Juan? Tyler? Kylie? Tyler? Antonio? Jane? Gregory? Nathan? Lucas? Matthew? Gabriel? Julia,
Here.
Zachary, Zach, Kate, Preeti, Brendan, Noah,
Yeah.
Dom, Skylar, Zachary. Okay, I hope you have done the form. Those who have just joined in the pre-class activity, you have a form here. You can do it fully. And before we get into our discussions today, quickly on the assignments and other things, if I got some emails on the technical issues of the Connect. So in that regard, I'm helpless. You should directly call or email Connect people. They can help you directly. And beyond that, if there is an issue, share that with me with a screenshot. I'm there to help you. If they say that, no, 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 it is not our problem, professor had to do it, kind of thing, maybe, right? You can share that with me. And yeah, that's it. I want to quickly share that with you. And today we have, uh, and about the week, I think this week you have a little load on you. You have only one chapter as the assignments to do this week. And we'll have the discussions, maybe probably extended to the next week. And we'll also have an activity this week. So this week is all about Federal Reserve systems, which is the base for money markets through monetary policy. So let's go with that. Okay. I hope you're aware of this. In all the sessions, for example, in the last week, we have the pre-class activity, in-person and post-class activities. In the post-class, we have the class videos. Some of you are late, some of you are missing, some of you want to go through the class again. You can go through it. I'm making those things available to you. Make use of it if you want. Okay. So in general, out of the coursework and out of your program at university, did you ever had an importance for anything related to federal system or Federal Reserve Bank in general as a layman? Did you ever hear about it, talk about it before our sessions? Yeah, may I know regarding what?
I don't know, like in a bunch of my classes, they talked about this.
But you're not sure what was it about?
I mean, it's like a central bank.
Okay.
They control and do monetary policy. It's like
Okay. So it's again an academic discussion, right? Okay.
Like they determine the interest rates.
They determine interest rates, good. Okay, you guys are more into concepts actually. I appreciate that. But I'm asking you in general. In general, do you see your family members talking about Fed, Federal Reserve Bank, and so on? Maybe Fed rates. If I say Fed rates, yeah, I think that is more important. Fed rates are everything for all kinds of loans, investments. Importantly, the real estate market. I think Lucas is not here today. Fed rate is everything for the real estate. It hits a lot for every cut or for every rise. Okay, so that's very important to understand if you are a borrower or investor. Either way, demand side as well as supply side. If you're working on that, that's what we discussed in the earlier class, as you mentioned, what determines interest rates increasing, interest rates getting down. So the demand side, who are the borrowers. Maybe there are some investors who borrow and invest. Then supply side, the banks. or the financial institutions our topic is all about. So in that way, we are more worried about Fed rates. So before we get into Fed rates, like we discussed about interest rates in the previous session, we should know more about who determines. We concluded in the previous session that it is all the economic factors that determine demand and supply conditions. Can you quickly recall what determines interest rates that we had in our previous week discussions? Why interest rates go up or come down? From the previous class, nothing beyond that. Yeah, supply and demand of
Something funds.
funds, loanable funds, or loans, you can say that. Conceptually, we are using that, right? You can use any word. So when demand for loans increase, interest rates go up. When demand for loans decrease, interest rates fall, right? And you take the supply side. When supply increases, what happens to interest rates? Supply increases, interest rates. There are more banks willing to give loans. What happens to interest rates? They go down. There is more supply. Same law of demands. It is applied here. Yeah. More is the supply, less is the interest rate. High is the supply. I'm sorry. High is the supply, less is the interest rates. Or less is the, or shortage is the supply of loans, more are the interest rates. But our discussion in the last class was what influences demand factors and what influences supply factors. We discussed individually. Again, moreover, we also discussed about GDP, inflation, which are macroeconomic factors. And at the individual level, in the rise in wealth of the suppliers or the financial institutions or the banks also makes them to supply more. Okay. And we also discussed about there could be some non-economic restrictive factors or non-price factors which reduce the demand. Okay. So that's how we discussed. Continuing the same discussion now. So there is an authority to make the interest go up or come down. It's not that banks like stock markets or oil markets or any market you take or commodities market. It's not the market which makes or fixes the interest rates. It is the system in any country. It is a system or monetary system which fixes the interest rates. The head or the chief of the monetary system is central bank for many countries. In US, we have Federal Reserve System, which has a sole authority to command interest rates, which influences money supply in short term as well as long term. Moving ahead on this, today we'll be discussing about, to start with, what exactly is a federal system. Usually most of the countries have a bank, as one single bank, which is the chief of the whole central reserve system or monetary system of the economy. But in US, we have a different system. Okay. And that system is closely associated with monetary policy, which means it's a kind of tool for the Federal Reserve System to influence the interest rates through monetary policy. So let's start with that. Thanks to FAU, I think last week I was asking the technical support team. I'm not able to help my student because I'm not able to write on the monitor so that you can see there. I think within no time, on the same day, they have provided the smart monitor for us. In the coming sessions, including today, our discussions will be more fruitful when I write something on the screen for you instead of writing on the board and getting away. Okay. So this is what we have for the day. So we'll be starting with actually the structure of federal system, then its functions, what exactly does it do, then what are the tools of federal system which you call them as monetary policy tools. Then we also see how does this monetary policy change given change in macroeconomic variables. Can you give me some examples of any example of macroeconomic variable or macroeconomic factor? Any macroeconomic factor? Inflation, GDP or GNP or per capita income, industrial index or unemployment rate or falling unemployment rate, exports, imports, foreign trade, money supply, foreign investments, all these are economic indicators. As a common man, we all are worried about GDP, inflation, and interest rates moreover. Okay. So here, why I'm talking about them is when we talk about economic variables, they influence monetary policy. That's the idea. Okay. Macroeconomic factors make the federal system or the concerned person or concerned bank, which is the chief of the monetary reserve system, to change the monetary policy. Okay. So that's the impact of economic variables. Economic variables are not commanded by anyone. It is market driven. Prices or anything. Then we also look at how central banks, I think the same concept extended to the world beyond US. How it happened, we'll have some interesting facts on that. How do they adjust their monetary policy, importantly during financial crisis? This is what we have. Then, so coming back to the concept of a central bank, we are talking about financial institutions, mostly banking, dominated by banks, commercial banks. So all these financial institutions, they need to follow the rules and regulations of a central bank. So we need to know more about a central bank. So what do they do in any country? What do central banks do? To start with? They are more worried about the monetary policy. When we say monetary policy, it is supply of money and interest rates majorly. If governments or central banks, they want to increase the money supply, they bring down the interest rates. That is the link. If they want to cut down the money supply, they will increase the interest rates. When this happens, when there is a shortage of demanded funds demanded and supply is not meeting them, there is a shortage. So for that, what do? Is they cut down the interest rate so that supply of money or loanable funds increases. When it happens, when the economy is booming, when the governments, they design their policy in such a way that their GDP will go up. If that is the policy, they try to bring down the interest rates. That is one way of looking at monetary policy, to increase, to cut down the interest rates. In contrast, quite opposite, interest rates will go up. Why? Inflationary tendencies. When the policymakers look at the economy that inflation is high, it is at a very cautious level or dangerous level or abnormally high, they try to increase the interest rates. Why? So that demand for loanable funds will come down. Economic activity will little shrink. So the demand for goods and services will come down. Prices will come down. Inflation will come down. Okay. So again, to take care of this monetary policy, central banks, what do? They determine, implement, and control the monetary policy through their tools, which we'll discuss in the respective countries. So in US, the Federal Reserve System, it is known as the Federal FRS, there are many names for this, all mean the same. It is the central bank of US. So it is completely independent. Federal government doesn't have any intervention in this. They may influence directly or indirectly. That's a different scenario. But they are autonomous. They're independent. They take decisions independently. So this system started in 1913 through an act called Federal Reserve Act through the Constitution. The structure is moreover like this. It comprises of a board of governors, which is headquartered in Washington, D.C. And it has 12 Federal Reserve Bank. This is interesting compared to other countries. And it also has a Federal Open Market Committee, FOMC. This is what everyone looks for every quarter to know the Fed rate cut or raise. FOMC makes the decision to cut the interest rates or increase the interest rates. Okay. So this is the basic structure of Federal Reserve System formed in 1913. The first part of the Federal Reserve System, or FRS, is a Board of Governors. It has 7 members, and each member is appointed by US President and must confirmed by the Senate. I think you know the process, constitutional process. In the Congress, it happens. And they have a term of 14 years, and it is non-renewable. 14 years means done. Some may go out because of health reasons or age or other factors, but 14 years is the term. So what do they do? The prime responsibility is formulation and conduct of a monetary policy. So formulating and implementing or executing it is the prime function or responsibility of each member or board of members put together. And once they do that, they also need to supervise and regulate the financial institutions or the banks. Okay. So this is about Board of Governors, the first pillar, or you can say, of the Federal Reserve System. And the second one is, this is very interesting compared to other countries, very interesting. It has 12 Federal Reserve Banks in cities across the country. Okay, how does it happen? We have 50 states. It does not mean that Federal Reserve System has 50 banks. No, it has only 12, which are affiliated with set of cities, which I will show you. Okay, so broadly, I think you have the list here. Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. These are the 12 Federal Reserve Banks. So if you're talking about a Federal Reserve Bank in Florida, maybe it is related to Federal Reserve Bank in Atlanta. Got it? So a Federal Reserve Bank in New Jersey, it is affiliated or related to Federal Reserve Bank in New York. You should identify. It's a good exercise if you know, if you are from different states. If you are from Florida, I'm sure it is from Atlanta. If you are from other state, just point out where is your Federal Reserve Bank. So what it does is, all the banking activity in that region is the responsibility, or it is monitored by the respective Federal Reserve Bank. So that's what you call it as depository institution. Depository institution means whatever the, for example, capital adequacy ratios are there, each bank has to maintain according to Basel II norms or whatever, Basel III norms. And other banking regulations are there. This Federal Reserve Bank will ensure all its banks under its area, in its city rather, they are following the rules and regulations or not. Not only that, if at all the banks do have a deficit money, they can borrow from the local Federal Reserve Bank. That's what you mean by a depository institution, which is there in each Federal Reserve District. So, but they all fall under one umbrella that we discussed in the previous slide, Board of Governors. The Board of Governors are the dictators for these Federal Reserve Banks. Federal Reserve Banks are not independent. They follow the instructions of Board of Governors, which are 7, which are headquartered or located in Washington, D.C. And within that, each Federal Reserve Bank has a 9-member board of directors. Okay, I think this may be useful for your conceptual testing MCQ questions in the assignments or your exams, mid-exam or final exam. Then nationally chartered banks are required to become members of FRS. Okay, so that's what I was talking about when we are talking about depository institutions for the banks. That's how they are related. So you can see these are the 12 Federal Reserve Districts. These are clubbed like this. Yeah, as I was telling you, Florida is associated with Atlanta Federal Reserve Bank. And this area looks bigger. And New York becomes much smaller. Okay. I think in your basic classes, like fundamentals of financial management or principles of financial management, you have studied in your first year or second year. There you might have gone through the organization structure. What are the types of business organizations? Can any one of you tell me? Business organizations. You got my question? Yeah.
I would like, are the board that for like each individual Federal Reserve selected by the president also, or is it by the state or that they're in?
No, that happens within federal respective Federal Reserve Bank with approval from the committee. That hierarchy is there. Did I answer the question? Yeah. Yeah, coming back to my question. Business you take Apple, we talk about Google, we talk about Nvidia and so on. We all know all these companies. These are the only form of companies which you are buying the shares and so on, or you have another form of companies. Did you get my question? Okay. Florida Atlantic University is there. Is this a business organization? Educational institutions, they are not business organizations. Okay, because they are not profit oriented. Business organizations are the organizations which are profit motive. They look for profits. Okay. You go to, when you drive on the road, you find a lot of shops to your left and right across the street, across the road. They're also doing business, right? Apple, Microsoft, they're also doing business. What's the difference between a street side business, small business house, business retail, and big companies which are listed in the stock markets? What's the difference between these two? Yeah.
Ownership is different.
Ownership, got it. I take it, you're right. Then anything else? Okay, I tell you, the difference is the nature of organizing this business or I'm not talking about the way they're doing business. How the ownership, like you're talking about ownership, how this ownership is organized or structured, that is important. You may have basically private form of business organizations and public form of business organizations. When you say public, anyone can be a owner in that company. Shares are offered to the public. Okay. Private means no, they're not offered to the public. You might have heard about sole proprietary partnership firms, you know, private limited firms and LLCs. LLC is a popular form, limited liabilities and so on. So why I'm asking you this is, when you look at these Federal Reserve districts, New York and New York is very small. I think in the first class, when you're talking about a quick talk about financial markets, we differentiated debt and equity. Debt has no ownership. Equity has ownership, right? Debt has a maturity. Equity doesn't have maturity. It is forever, perpetual. And one important thing is, when something goes wrong with the company, the debt holders or anyone who the company owes to anyone will be claimed on the company's assets only. They can't claim on shareholders' personal assets. Okay. For example, you started a small business by yourself. Maybe you have a big plans for startup, but you are started now with a small business. You borrowed from your bank. For example, the business didn't do well, then banks can claim on your business assets as well as your personal assets. They can possess personal car or TVs or mobile phone or anything. But you have a limited liability companies, LLCs, which could be our public firms, public limited. Which limited itself means any creditor can claim only on the assets of the company, not personal. Why I'm talking about that is, in the olden days, maybe that was in 17th century, if I'm not wrong. In fact, everyone used to claim, if something goes bad with the company, they used to claim on the shareholders' personal assets also. It was there. But New York was the first state in the country which offered the companies to form the organization with a legal situation that if there is a bankruptcy, they cannot claim on shareholders' personal assets, which they called as public limited company. That attracted majority of the businesses in the country to put their shop in New York. It also happened with New Jersey, Delaware, and so on later. That's the reason you see there are more business houses in New York and so on. Of course, California, Silicon Valley is a different story, but I'm talking about centuries old reason behind this. Okay, so this is how you can see your 12 Federal Reserve districts. Then the third part of your Federal Reserve System is FOMC. So as I told you, it is all about increase or decrease or no change in federal rates. They need to meet every quarter, at least 4 times in a year. They meet in their headquarters, Washington, but typically meet more often if it is required. Some recessionary conditions are there. A stamp blew out. There was in pandemic situation in 2020, they met quite frequently how to deal with the monetary policy in this situation. So if there is a pandemic activities in the economy, they come into the picture. It could be every month almost. So the main responsibility is to formulate policies. It's all about economy, employment, GDP, inflation, and foreign trade. These are the broad areas precisely. Okay, they look at promoting the business and economy seen through GDP, which results in employment, but they also take care of price stability. When income increases, more demand for goods, prices will also increase, leading to inflationary tendencies. And they also look at net foreign trades. That's what current government is doing. Then they also set guidelines on open market operations. This is all about securities. Okay, I think this we talk more in money markets about open market operations, T-bills or government securities. And the last one in this is there is, I think, more. If you want to know more on this, you can get into the book reading. But these are the main reasons. But I missed something here. The FOMC is the key body to announce Fed rate cut or Fed rate raise. Okay. By the way, what is the Fed rate right now? How much is that? Can you quickly search and tell me? How much is that? How much is the Fed rate right now?
3.5 to 3.7. So it's like
When it got implemented? You got the date? Since when?
this January.
Good, that's good. Since January? Before that? Can you? How much is the Fed rate now? And how much was before that? Yeah. Okay. Do you find anything before 3.52 anytime?
It was like 4.25 in October or November,
October, November?
like around there. It was like 4.5 in the beginning of the year.
Can you search and tell me the source? Because I want you all to be good in that. That's the idea. Sorry?
When do you want the previous one? From when?
Which one?
Like, when do you want the previous rate from when?
Yeah,
From when?
yeah.
When?
I'm asking you.
No, I'm asking. Well,
Because
I have here, I have a whole
my
chart.
idea is Fed rates doesn't change every day or every week or every month like our bond yields we have seen or stock prices. They are declared by FOMC.
So it's 3.75 as of December 10th, 2025.
3.75 as of December 10th. Okay. Anyone else? I will show you all those things in the later classes. We'll be discussing all about it. But if you are personally into it, you'll be well connected with the class. That's the idea. Okay. So again, to remind you, Fed rates or monetary policy rates doesn't change frequently. They keep changing whenever FOMC meets and declares. Okay. There was a huge cut in the pandemic times. Then later it was increased. And from there onwards, I think 2024, from 2024 December, that was the last time when they met, or November. Since then, there was no price cut. Everyone was waiting for that, actually. Importantly, real estate industry. But then very recently, in the month of December, they gave a Fed rate change. We'll discuss more on that. Then the duties and responsibilities of the Fed Reserve put together to conduct monetary policy, supervise, regulate depository institutions, maintain stability of the financial system. So what do you mean by maintaining stability of the financial system? So when we talk about financial system, it's all about financial markets and institutions. Okay. And maintaining stability means what it could be. Financial markets, financial institutions, and we are talking about stability. It is all about the supply again. Supply and demand should be in equilibrium, neither should be in deficit nor in surplus. So they try to attain an equilibrium in all the markets that we are we're referring to as a financial system. In addition to that, this federal system offers services to US government, the federal government, to the public. I think Federal Reserve System is advisory for government whenever it makes fiscal policies or policies related to some industries. When it wants to pump more money into one sector, like microchip, federal government wanted to boost that industry in US. They wanted to invest more in that. So the Federal Reserve System advises, are we in surplus? Are we in deficit? Does your goal match with the available funds? They do advise on that. And on behalf of US government, Federal Reserve System, they issue treasury bills. So they issue treasury bills to the public. Securities are available. And of course, there are no financial institutions without Federal Reserve System. And not only domestic, your foreign institutional investors, they're also part of Federal Reserve System. Okay. So that is the structure, initiation, functions, duties, and responsibilities of Federal Reserve System. Further, specifically about Federal Reserve banks, I think it is designed, the monetary policy is designed by Federal Reserve System put together as a whole. Okay. But it is implemented by Federal Reserve banks. They play a vital role here. And conduct means execution of the monetary policy. The discount rates varies according to the monetary policies. When the institutions buy or sell the securities, we have the discount rates. We don't have the prices. When we talked about the yields last time, actually it's not the return or the prices, it's all about discounts. Bonds are always traded on discounts. I'll show you when we get into debt market and money markets in the later sessions. And to supervise and regulate, each FRB has a state chartered member bank and bank holding companies in their districts, which is one among all the 12. Then they also take care of consumer protection and community affairs as they implement federal laws. So when you talk about consumer protection, there could be many people who want money, desperately need money, and if there is no protection by the FRBs, then institutions may charge very high interest rates looking at their demand, because borrowers, they don't care, they want money. They may be uneducated also. They're not in a situation to understand what is interest rate. What they look at is, I want money. I want $10,000 today. I want $50,000 today. Okay. And they also serves to US Treasury as a commercial bank. They do like we have a checking account, they have the checking account for the federal government or US Treasury. New currency issue, remember, US dollar is completely different when you check with other companies, other countries' currency. How it is different? How US dollar as a domestic currency is different from a UK sterling pound or Chinese yuan or Indian rupee. How US dollar is different? Can anyone of you guess? Is it the same at least? Are they different? US dollar as a domestic currency in US and domestic currencies of other countries, how they are different, or are they the same? What do you think? Yeah.
Don't a lot of other countries try to match their currency to the US dollar? That's
I agree with you. Maybe you're talking about exchange rate, right? But what I'm saying is, example, there is no exchange rate, there is no exchange of currencies. Of course, there should be there. But still in the current scenario, there is a difference between US dollar and currency of any other country. What's the difference? What do you think? I think you're right. What you said is right. But how do you see that? Every country, what she says is, there is an exchange rate between currencies. Yeah.
US dollar is used everywhere in the world.
Exactly, as simple as that. US dollar is used as a currency even out of US. You can use US dollar everywhere in the world. It's not the case with other countries. Of course, nowadays Euro dollar has come, but it doesn't belong to one single country. It is a union of many countries led by Germany. Okay. Now BRICS led by India, they're trying to have a common currency. That is again a common currency. But there is no single country with a single currency as of now, except US dollar. Why I'm talking about that is, when you talk about new currency, it is influencing the global economy, not just US economy. Okay. And not only that, the problem for foreign countries which owe US dollar is, many of the countries, they say that whoever holds that currency, they are supposed to get the equivalent value in return. It's a kind of, it's a fiat money actually. That's not the real money. It's a fiat money in economic sense. But in US, that kind of promise is not there. So these are the differences when you talk about US dollar and other dollar, which makes the difference in policies in terms of new currency issue. See, I think, new currency issue is a big problem to many countries. I think in Zimbabwe, if I'm not wrong, they tried once to pump more money and bring people out of the poverty. They tried to issue more currency. That led to inflation. Everyone is rich. Okay. More currency also leads to a lot of problems. Recently, Venezuela, we had that problem. A lot of currency got into the money, lot of prices going up, inflation. So currency issue is not that easy in US scenario. Then they also do a typical clearing and settlement activities. They take care of wire transfers, and moreover, they provide a lot of data for corporates and academic institutions like FAU to do research, which will be very useful for policy making, monetary policy making, to change the policy, to increase the rates, to cut down the Fed rates. Huge data is there. It provides free of cost. So like any bank has, it also has a balance sheet with liabilities and assets. So major liabilities are currency in circulation and reserves. What are the reserves? Like I was talking about issue of currency. Currency is not just printed or minted. Every country should have a value. That value is denominated in terms of gold. Okay. More is the gold, more is the country's capacity to supply or print money. Okay. So the Fed government, Federal Reserve Banks or Federal Reserve System, or simply Fed, they have the liability of currency in circulation as well as reserves in their balance sheet, which it is termed as monetary base or money base in economics. In macroeconomics, it is more popular. So these reserves are categorized into required or minimum, and anything more than that is excess or surplus reserve. Then you have assets, which are treasury bills on MBS and ABS, mortgage-backed securities and asset-backed securities, because a Federal Reserve, it gives the guarantee for MBS and ABS, sorry. Then again, interbank loans are also there, which form part of total assets of the Federal Reserve. That's the balance sheet, structure, functions, duties, and responsibilities of a Federal Reserve System. I think these are the numbers, little outdated, but still interesting, from 2007 till 2021. You have the list of assets here. SDR is special drawing rights. So total assets, which was, if I'm not wrong, it was 951 trillion. That was billion, gone up to 8.9 trillion in 2021. Then if you want to have more information, you can access free of cost. The whole data is available for n number of years. Since the historical event of Federal Reserve System, it is available. If you have patience to have that, you can go through it. Okay. So out of all the assets, US Treasury securities contribute to 68%. Followed by, what's next? What's next after Treasury securities? Do you see Treasury securities? It is close to 68% of total assets. What is the biggest asset after Treasury securities? Yeah.
Government.
Yeah, it is 30%. You're right. Similarly, the liability side, which one is the highest liability for the Fed? Which one you see? Depository institutional reserves, it is 41%. Followed by currency outside banks. Okay. Okay. When you want to conduct monetary policy, you should have tools. If you want to effectively execute monetary policy, you should have powerful tools. So these tools of the Fed are open market operations, discount rate, reserve requirements. Open market operations are in short OMO. The Fed sells government securities like treasury bills or treasury notes or treasury bonds in the open market. It sells a lot to take back the money, or it buys a lot to flush money into the economy. If they feel economy needs money, they try to buy a lot of securities so that there is more money into the economy. If they feel it is overheated, we need to take back. They try to suck the money flows by selling the securities. That is the important tool of Fed Reserve through open market operation. Number one. Discount rates. The rates will be more, means high interest rates. Discount rate is less, means low interest rates. Very simple. If discount rates are high, means high interest rates and high rate of lending and borrowing. They want to cut down the money supply. Discount rates are low, means they want to increase the money supply. Then reserve requirements. The reserves, the banks are supposed to give to local or Federal Reserve district banks, Federal Reserve banks, which we have in 12 Federal Reserve banks. So again, money supply has to increase means they cut down the reserve requirements. If the money supply has to be discouraged, means they will increase the Federal Reserve requirements. Okay, so this is how it happens through monetary policy. It is very simple. And again, I'm telling you, these things happen once in a quarter. It's not every day or every week. Once in a quarter, they try to go through it. And in median, if there is an urgency of some industrial activity or economic activity or foreign activity, they act immediately. They try to do that. So why do they do that? Again, macroeconomy, targeting GDP, inflation, prices, foreign trade. Okay, so these are the monetary tools that we have. And when you look at the flow, open market OMO is one. Then if you look at the flows, they are directly related to the reserves in the banking system as well as trade reserves. Okay. And here, when the reserves go, they go through a discount window loans, which are part of extensions which add reserves and which come through Federal Reserve, and which may also go results of the open market operations. And the sales will drain the reserves or cut down the money supply. Okay. So this is the kind of flow interrelationship. If you want, there are many flowcharts on this, but I thought this looks better and easy to understand for you all. So banks with excess reserves, they contribute to total reserves. And banks that want reserves, they take from the Federal Reserve. Okay. So this is the counter mechanism. Whenever there is a surplus, it comes down. Whenever there is a deficit, it increases. And further, these depository institutions trade excess reserves held at their local Federal Reserve banks. And these trade or transactions are called as Fed funds rate. Okay. So whenever excess reserves are held at the local Federal Reserve banks by the depository institutions, that you called as federal fund rates or Fed fund rates. Financial Services Regulatory Relief of 2006, they offer to authorize Federal Reserve to pay on reserve balances. There is something called IOER and IORR. These are the required reserves and excess reserves. Okay. So can you tell me in what conditions should Federal Reserve should regulate to increase the reserve requirements? In what conditions the Federal Reserve will be asking the banks to put more reserves with the Federal Reserve Bank? What do you think? Inflation? Primarily inflation. Okay. There could be some other reason also, but we can say they want to cut down the money supply. When they want to cut down the money supply, they increase the minimum required reserve to be with the Federal Reserve Bank. Okay, that's what we are mentioning here. So depository institutions with excess reserves held at their local Federal Reserve banks. That relationship varies. That's not constant. It keeps on changing. Okay. So this Federal Reserve can take two basic approaches affecting market for banks' excess reserves. We are talking about surplus. Okay. When they target the quantity of reserves in the market and target the interest rates on those reserves. So the rate, which is almost like a price for money market, and the quantity or volume of the loans is also important. Number of loans are increasing. What do you mean by that? What happens to interest rates? Volume, number of loans are increasing in the market. Say last quarter, 10 million loans. This quarter, by the end of the December, it was 20 million. It doubled. What happens to interest rates? They go down. So there was more demand. So more borrowers. What do I say? But remember, as we discussed in loanable fund theory, when interest rates are low, there is less supply of loans. Loanable funds, the lender's willingness to lend will come down. But how volume will increase? Because if you are not lending, they will go to some other bank. Competition prevails in lending point of view. That increases the number of loans even at the low rates of interest. That's where we talked about equilibrium. Remember the curve, the supply curve shifting to the left and right. Okay. So it's all about the quantity of reserves and interest rates. So this class is more of concepts. You can take that way. We'll be working more on the reality in the coming session. And extending on this, FOMC, it forwards the federal rate policy to Federal Reserve Board trading desk at the Federal Reserve Bank of New York to a statement called policy directive influencing the Fed rates. Then further that manager uses policy directive communicating to all the traders in daily amount of open market purchases or sales to contract. So that's how we see the Fed rate change going up or coming down. So of course it is a repetition, a bit of a repetition here. So this may make money supply to increase or level of interest may increase or Fed rate which we are talking about, or it may come down. It can happen either way. So we'll see practically more in the coming sessions. So this could be more with treasury securities, which means short-term treasury bills, long-term notes and bonds. So some interesting chart for you all. Please have a look onto the screen. Hold your work for a while. Look at the screen, all of you. MBS holdings stand for mortgage-backed securities, which are issued by Freddie Mac and Fannie Mae. So this is the picture from 2000, last quarter of 2006 till last quarter of 2001. So what's happening here? We have seen the balance sheet. Yeah, go ahead.
You said the gray is like recession.
Yes, like we used last time, the same thing. Can you see something from this chart? Yeah.
That is consistently trying to put more money into the
Economy.
economy.
Okay. So I think I can say they all are going together. They all are increasing and they dip together even. Okay. If at least in this period, if you see, I'm not that straight. From there, the total assets, MBS, and the treasury holdings. Remember, these two are part of this. Okay. So we are trying to see which one of these two is making move. That's the idea. Okay. So if you look at this, I think MBS are very flat, very insignificant here till 2002, third quarter. From there onwards, they started shooting up, and their maximum, they are above treasury holdings actually. When was that? 2009. That was post recession. 2008. You might have heard about it. Did you guys discuss anytime about 2008 recession and the reason for that? Yeah, I think maybe whenever the time permits, I'll be talking about it. As a finance student, you should be aware of it because that influenced everything, all economic and finance stakeholders. So here also we can see MBS, even ABS, they have dominated treasury holdings in by the end of 2009. Since when? In the from second quarter of 2009 till third quarter of 2010, they have dominated treasury holdings. Okay, but later on, treasury holdings continue to dominate in the total assets which we have seen in the balance sheet. What we are seeing here is the same thing. Did you see here? We have concluded that treasury securities are holding more, 68%, and government agency securities. We are trying to look at the same picture in a different way. Okay. There we use the word treasury securities, we are saying treasury holdings. That's the difference. Okay. So I'm just repeating, discount rate is everything for money market and debt markets. Whatever we see as a price or yield it is all about the discount rate that will be converted into yield or a price. Nowadays, it is done automatically by the computers. On the live trading also, you will see the yields. But usually, people give the discount rate. Okay. So, for example, a bond is getting traded for $100. They don't tell you $95 or $99, something like that. They tell you 1% or 0.01. That is the quote given. Okay. 0.01 means that is a discount rate that I am offering on this bond to buy. That's how the trade goes on. We'll see that in money market and debt markets. So this is the rate where all the FRBs charge on loans to FIs, financial institutions, which we call as Fed fund rates. And Federal Reserve used discount rate as monetary policy tool because of it is difficult to predict Fed changes, and it is also a signaling practice to know the discount rate. And again, some charts for you all. Some rates, trends since 1990. I think everything changes around 2008. If you look at US economy, I think most of the economies which followed, I think Raghuram Rajan, he's from Booth School of Business, University of Chicago. He was the Reserve Bank chairman of India. Why I'm talking about him is he was the first and only professor from US to serve as a chairman for a central bank of a country. Why I'm talking about him is in those days, he was the one when 2008 was in the crisis, most of the economies, followed by European economies, UK, France, even Japan, not China. What they did is they also followed the Fed cut during the US recessionary tendencies. When economists like Raghuram Rajan and others, they also pleaded Indian governments to bring down the, not government, Reserve Bank of India is also autonomous, pleaded the government governor, I'm sorry, of that central bank. Then they said that ours is a different economy, insulated. Maybe whoever is following US economy, they have to cut their rates. My point of telling you this is whoever has more investments in US at that time, invested more in MBS, more in ABS, they're tied strongly. I'm not talking about just the trade. I'm also talking about the investments at that time. So they're also mandated to follow the same policy. Why? Because they also had the same consequences. You can see how 2008 has changed the whole picture here. Okay, the rates have fallen from here till here. Prime lending rates or CD rates or T-bill rates or discount rates, everything has fallen down. You can see that. So which is very high. I think in 90s, it is around 10%. I think you guys will not believe. Interest rate used to be 10%. You may not believe it, but you can see the facts on your chart. Right? Now we have everything around 4%, above 4 or below 4, something like that. That's an interesting trend to watch or observe. Then to add more, this is all about the monetary policy tools. If you want to know more, you have the discount rate window to get into the details of depository institutions. This is a kind of reading, you can go through it. But the key Fed discount rates, the key lending programs are primary credit, secondary credit, and seasonal credit. Okay. Yeah. So you can go through them to understand more into it. It is very simple concept to remember. Like a we're talking about Fed reserves. We have the reserve ratios which are mandated, which means that there is something called Global Regulatory Agency on Banking called Basel II norms, where they mandate how much should be the capital adequacy ratio. Like that, we have reserve requirements for all the financial institutions, including the commercial banks. Okay. And continued on that. So there are some equations. I think this in your assignments point of view, conceptually, please take care of these two things. Change in bank deposits when it happens. Okay. So it is a factor of a new reserve requirement based on the forecast times the increase in reserve according to the reserve requirement change. Okay, so these things are more conceptual. Please go through them even after the class once. And to put all those things here in a simple chart, you have the broadly financial markets here, but we are talking about only this with 3 important components: OMOs, discount rates, and reserve requirements, which influences money supply and interest rates. Money supply, interest rates. Fed rates or interest rates are on loans treasury rates or discount rates, whatever you call it is interest rate. Then money supply, it's all about bank reserves, which is again changing based on the loanable funds demand and supply. Okay, and further you can integrate that to this. The objective is price stability, avoid inflation, economic growth, GDP, and maintain low inflation, full employment, and foreign trade. Take care of the foreign trade. Okay, sustainable. See, quickly on the foreign trade. What do you mean by foreign trade? Foreign trade. You all know about it. What is that? Foreign trade?
Imports and exports.
As simple as that. Imports means you're buying. Exports means you're selling. Selling and buying not in the country, out of the country. That would be very close neighboring state like a country like Canada or far away state. You are buying from a foreign country, you're selling to a foreign country. So which one you want more, imports or exports? Which one you like? Exports, because you want to sell more and buy less. It makes less dependency on foreign countries. And more exports means more dependency of foreign countries on you. That is a good factor, but not always, but not for all countries. Again, as I told you, US dollar is globally denominated, accepted as a currency. Okay, so for US, it's not a problem. But for other countries, like we are talking about foreign reserves. When you talk about reserves, it is about gold. But foreign countries or non-US countries, it is more about reserves of US dollar, euro dollar or euro and gold put together. So for US, it is not that complicated, but still they need to ensure sustainability pattern, because they should understand why are we exporting. There is a domestic demand and you guys are selling out of the country. It is not a good pattern. You have surplus, you're exporting. That is good. Okay. Similarly, importing, if it is not available, buy from other country. It is available here and you're buying from other country, that's not good. Okay. So to summarize all that, this is the picture what you can get to understand the Federal Reserve System and its objectives through its tools. Okay. So what are the tools? These are the three tools of monetary policy. How it happens? Through money supply and Fed rates. And broad effects, you can see them with expansion activities and contraction. Contraction is cutting down. And I just gave you an interlinkage, increases or decreases. Some updates on this. This is the how shift in going up and coming down. This is also interesting. Demand increasing and decreasing. I think these are some numbers. You can go through it. I think that is all we have. Any questions on this? Okay. For the next session, we'll be having an activity, and that activity will be based on your understanding. Okay. And you will be applying them in real time also. So for that, for the next class, please have good reading of what we have discussed and go through the smart book also again. That will be very useful to you. Okay. Let us stop it for the day.